All right, I just want to make a couple quick announcements. So first of all, thank you, everybody. We're just going to get into this. I know more people are going to jump on, but I want to respect everybody's time. Thanks for being here. And Harry, it's very hard for me to get Harry. He's very busy servicing our clients, but he called me up and said, Paul, we need to do this end of the year live webinar. There's a lot of really important things going on. For those of you who don't know, Harry is the founder and senior managing partner of our law firm, BarthCalderon. We're an asset protection, estate planning, business planning law firm located in Orange County, California. This is our building there. And we've got about 10,000 clients across the country, servicing really good people at all levels of planning. And for those of you who take time to get on a webinar with us like this, we always want to offer you the chance to get one-on-one with Harry and the team for a complimentary planning assessment. Now, this is going to be, as Harry was mentioning to me before we started, there's going to be some nuance to this one, some technical stuff here, really good things going on. And so if you have questions that come up, we're going to try to answer questions here, but also you can get one-on-one with the team. And I'm going to put in chat a link. If you copy that link, click on it, you can fill out a very brief online intake form, and that will get you connected to me. I'll get you scheduled with with Harry, the appropriate attorney, depending on what you need help with, and we'll go from there. And Harry is our top speaker at the firm. He's in very high demand across the country for the educational webinars like this that we do. And we speak to Vistage International, the Women Presidents Organization, the Entrepreneurs Organization, apartment associations, wealth management groups, investor groups, business groups, and we do about 50 workshops a year. So this is going to be great, lively, and look for that link in the chat. And Harry, let's take it away.
Thank you. Well, good morning, everybody, and welcome. Boy, interesting things to talk to you about this morning, and there should be significant takeaways. Well, we had an election, didn't we? And irrespective of the politics, the dynamics of that election are the subject of our conversation together this morning. But just before I get to that, two other quick issues that I want to raise. I'm sure many of you know, if you don't know, that the Corporate Transparency Act for the moment has been enjoined by a district court in Eastern Texas as unconstitutional. Now, what does that mean? I just want to make it clear that does not mean that the Corporate Transparency Act is unconstitutional, nor that the Corporate Transparency Act is no longer in effect. What it does mean is that probably the December 31st, or more likely than not, the December 31st filing deadline for your businesses is going to be postponed. So our firm's position on this is very simple. If you filed, that's great. If you haven't filed or you're in the process, complete it. If you haven't filed, I think you should still file, get everything analyzed and file under the Corporate Transparency Act, because my professional opinion is it will be back in some form or another, and then we're going to be in a rush. But I don't think that we're under the same rush that we were before on December 31st. So that's the latest and greatest. The Treasury has already filed an appeal on the Corporate Transparency Act. So that's my firm's position on CTA. The other thing I just want to jump in before we get to a bit of politics, which I hate to do, but we will, is that there is a new law that takes effect on January 1st in California that was signed by Newsom in September of 2024, and it's not necessarily a good one. So effective January 1st, 2024, retirement plans, the asset protection of retirement plans in California has been somewhat modified. So always in California, an IRA, a traditional IRA, did not receive, under California law, complete asset protection. The amount of the IRA that was protected from the claims of creditors was an amount that was reasonable and necessary in a determination by a court, and the California courts were pretty miserly in its interpretation. So we always had an issue, and although in most states Qualified plans, IRAs are completely protected. In California, IRAs were not. However, um, 457 plans, 403B plans, and 414 plans, not 401 plans. So not your 401k, that's ERISA qualified, not defined benefit plans, profit sharing plans, not those. I'll make it very, very clear. But um, but 403 nonprofit retirement plans, 457 public municipal workers plans, and we'll call cooperative types of plans were protected in California, and the income from those were protected. Well, effective January 1st, 2025, those plans, which were protected before, are now going to be treated on that same reasonable and necessary test. This is a diminution of California with little asset protection we had here. So we need to take a look at that more carefully as we move into next year. It doesn't affect the majority of retirement plans that are covered by ERISA and under federal law, but it does affect more than others, so it's something we need to take a look at. Okay, an election. So let's talk about the election a little bit and what it means. So, and we're gonna focus mostly today on estate planning because, as many of you know, over the last number of years, there was a great anticipation that the bonus exemption amounts for estate planning, which are going to be round numbers on January 1st, 14 million per individual, the amount that we can pass to the next generation without the imposition of federal estate tax, is set to automatically sunset on December 31st of 2025. That sunset, that's automatic, was going to bring that exemption amount down to $7 million. That's a $7 million per person decrease, $14 million decrease for a married couple, and an increase in taxation to our children and our heirs of close to $5 million. That is set on automatic. We were also very, very concerned in the event of a Harris victory that the Warren plan was going to be adopted, and that would turn around and have lowered those exemptions from 14 million down to 7 million, $3.5 million per person, and a 55% estate tax for everything over 7 million. Absolutely absurd, but that was the proposal, and had we had a sweeping Democratic victory, that's what we would look at. Now, a lot of people believe that now that we've had the election results that we've had, that we don't expect to have new taxes to be imposed upon the wealthy. There's a belief. And but I want to talk to you about the governmental issues that we face and therefore the planning that we need to do. So the first issue to understand is that we have everybody who is doing planning, spousal lifetime access trust, and other types of gifting to children may now feel that, oh, well, that the urgency is not there anymore because of the election. I think that we have to take some pause on that. So let's understand what we're facing. A lot of promises were made. We have promises that were made with no tax on tips, no tax on overtime, no tax on Social Security. It has to get paid for somehow. And in the election, although the Republicans control the White House, the Senate, and by a very slim majority, the House, the issue is that we do not control, the Republicans do not control a 60-seat filibuster-proof majority in the Senate, and that has an impact. So there's about 54 senators that are in there. So what has to happen is as follows. We have two things of concern. One, if Trump or the Republicans are unable to sell their tariff plan and they want to give the more common income tax deductions as promised, there's political cover, ladies and gentlemen, that the automatic reduction that takes place on December 31st, 2025 will happen. We call it now the elimination of the bonus estate tax exemptions. This is a very big concern. and it could very well happen. And they may take it up in 2026 and puts us into a never land scenario. The other scenario that we have to face in understanding is that since there are not 60 senators that are going to go along with this, the only way that they could do it with a majority in the Senate is through something which is known as a budget reconciliation. Now, in budget reconciliation, they have to kind of, say, okay, we want to change this tax policy. We'd like to at least maintain the $14 million per person, $28 million per couple, as most of us believe will ultimately happen, by the way. Um, but in order to do that, we can't extend it longer than 10 years under this rule. That's what's known as the Byrd rule. So the BYRD rule that's taken and in place. So under the Byrd rule, under budget reconciliation, if we are able to get the majority to agree and take up this type of legislation without it automatically sunsetting, I would think that there's a relatively good chance for the $28 million per couple exemption amounts to remain. But we have to be cautious and we have to have some concerns. And I'm going to give you some tools and tips today about some of the things that I think that should be done. So first of all, for individuals that are fortunate enough to have net worths that are greatly in excess of the 14 million or 28 million dollars for a couple, nothing's really changed. We would still want to make sure that we lock in that 28 million dollars for the family, that all of the growth on that 28 million dollars is out of your estate, and more importantly, and very succinctly, in much of this type of estate planning, we get a significant amount of asset protection around those assets that have been placed in trusts that are designed to get us this type of protection from the government. So I think that's very important. And I also think it's very important to understand that uh, intra-family discounts, grats, sales to intentionally defective grantor trust, tools that we have are probably no longer in jeopardy. So we still will have the tools available to us in 2025 and hopefully further to help plan our estates. So I think it's critical to understand that for those in larger numbers, planning should be moving forward full force, very little impact. If we keep the $28 million exemption, if we lose it, it's $5 million. So we can lock it in 2025 and should. But what about the people that are not ultra wealthy? People that are in the $20 million, $10 million, $9 million categories. The concern that we have there is what do we do? All right. So one of the things that we have to be concerned about is this exemption falling to $14 million. But nobody knows. So he puts us in a conundrum. Nobody knows what they're going to do. So if we say let's wait and see and not engage in any planning in early 2025 and kind of wait and see towards the end of the year what's going to happen till we see what Congress and President Trump does and should politically because it's this is all about common sense. If they want to give these tax deductions, income tax deductions, and the tariffs are not implemented yet on the budget reconciliation, we may be dropping to 14 million. And now all of a sudden it's October or November and everybody's in a panic. I can assure you or tell you that there will not be enough qualified estate planners or appraisers to deal with this particular issue at the end of 2025. So we need to start thinking about some of the things that we can do now. So what can we do now? So I want to bring out to everybody today one of the first things that we should consider. So rather than worrying about more complex and expensive definitive planning, let's turn around and do and create something which is known as standby planning or standby trust. Now, what do I mean by a standby trust? We create simple, in our own jurisdiction. We don't have to reach into Nevada or Wyoming or Delaware. We create some irrevocable trusts for the benefit of our spouses and or our children. And we we put all the provisions in there as if we are going to make that gift. So we have the skeletal structure of the trust completely put together. Now, not overly expensive. It's overly not simple. We don't need third-party professionals. We don't need trustees in other states. There's an awful lot of things that we don't need in getting this established. And we put a nominal amount of money. Maybe we put $1,000 of cash or assets inside this trust to have it valid. And then for this trust, we open up a bank account or a brokerage account with that little bit of money in it. We complete assignments, but don't sign them for entities and or for real property. That we just complete them and have to set them aside in the file, and we are good to go. And so now what happens is that if we anticipate that this we're going to lose, you know, $14 million worth of bonus exemption and a $5 million plus increase for our children, we just begin to effectuate the trust. We now bring transfers across into already existing brokerage accounts, already existing assignments get signed and notarized at that time. This is easy to do, and the skeletal structure of the trust is already in place. This is known as a standby trust. Now, one of the things we probably wouldn't be able to do other than stocks, bonds, and cash, which doesn't require appraisals, when we're dealing with appraisals on real property or dealing with appraisals on an entity or a share, which already is signed and done, but not signed and executed, but already completed, is we use something which is known, it's a little bit technical, something which is known as a Wandry provision. Now, what a Wandry provision does in the trust is because we've kind of recognized that if we're making gifts towards the end of 2025, that probably the appraisals are not going to take place for the amount that we've gifted to that trust until sometime in early to mid 2026. Most of us have a pretty good guess of what our assets are worth. So we fund it the way it is. And Wandry allows us to kind of make adjustments, post funding adjustments, so we don't overfund our trust and get involved in a gift tax scenario. So it's a little bit tricky in the way in which it's done, but a standby trust, I could tell you a standby trust are probably a very, very, very good thing to do. We were even completing a standby trust back in 2023 and 2024 already in anticipation of what just happened. So I think all of us should take a look, see if we're in that area. And then the other thing too, let's say we decide not to go forward with it. Not going forward with it. We're not going to move forward. We kept the 28 million. 28 million is enough. You all felt comfortable with it. Well, we just take the $1,000 that we have in, give it to the beneficiaries, and close down the trust. Done and finished. On the other hand, should we need to put it on steroids, we would name a trust protector in the trust, which will allow us to change the jurisdiction, for example, to Nevada, name professional trustees that we could put in there, do all the things that are necessary to effectuate a real good trust. Now, remember, highly important to remember that although we're now talking about estate taxes and the loss of the bonus exemption, all of the assets that we've placed into these trusts are asset protected from the claims of third party creditors. I can't tell you every week what I go through with people that are in jeopardy of losing significant amounts of their assets, but failure to plan properly. So if we were able to put 10 million or 12 million or $15 million worth of assets into these types of trusts that we designed for keeping the bonus exemption, we'll also pick up all the asset protection around that as well. And if we want to be more finite, there are ways that we can turn around and create what is known as non-grantor irrevocable trusts. And for those of us in California, we may be able to shift away from high California income taxes to a non income tax state using what we call non-grantor trusts that would give us a great opportunity to do that. So I think we've got to take a look at everything. I think that planning needs to move forward very succinctly. I think we have a little bit of runway to look at it, but to ignore it and say this is going to go away, it's not going to drop to 14 million, is reading the tea leaves when it comes to Washington. mean, ultimately, I think we'll keep the 28 million, whether we keep it in 2025 or not, I don't know. But we also have to be concerned about 4 years after these 4 years. And the new administration comes, and there we go again. So while we have the opportunity, while we have the tools, planning needs to move forward full force. So the next type of trust, which is interesting that I want to share with you today, that we can utilize is something called a Q-tippable trust. Now, a Q-tippable trust is primarily used or only used with married individuals. Have to have married individuals in order to do this. And Q-tips are kind of funny. It's whereby Harry would turn around and make a gift of assets to my wife during my lifetime, and it's written in such a way. It's called Q-tip trust, qualified terminal interest and property trust for the benefit of my spouse. So, and I'm concerned about, I don't want to use up my exemption if I don't have to. I'd like to kind of build an option. This allows me to build an option. What this allows me to do is wait many years, sometimes if necessary, to determine whether or not I'm going to Q-tip this trust for the benefit of my spouse. It's an election that's made on the first estate tax return to be filed. Kind of check the box to get the Q-tip election. Now, what does that mean? If I make the Q-tip election, then I don't use up my exemption amount. I keep it. So if I still have the $14 million, I keep it because it's not going to go away. And I have a trust I established for my wife. That trust has asset protection. That trust will get a step up in basis, you know, in the event of my death. A lot of really good things that happen, but I won't use up my exemption. Now, if I do it this year, I don't have to make that Q-tip election until October of 2026, which gives us plenty of time to understand what the government is going to do. In the event that the bonus exemption is going to be eliminated, all right, on December 31st, 2025, or even in early of January 2026, if it happens automatically, um, then what I do is I don't make the Q-tip election as late as October of 2026, and now it uses up the 14 million that I have. So I kind of get a chance to wait and see whether to use it or not. And believe me, yeah, on that, that's worth, $2.5 to $3 million or more to my children. So I want to take a look at that. Now, in addition, there are other things that could do. If we create a trust in early 2025 and make a bunch of gifts to children or between spouses, there is a concept which is known in tax law as rescission. So, as long as we're within the same tax year, sometime within 2025, we can go about rescinding what we did. So we have get prepared, we make the gifts, we set up the trust, we put everything in anticipation of that 28 million dropping down to 14 million. Then we find out in June or July, the government's went to work. We're going to keep our 28 million. Okay. And we don't want to do this anymore. We can enter into rescission and put everything back into place as if it never happened. But in the meantime, we have something done as an opportunity. So I think it's going to be impossible to determine what is going to happen, but we have an opportunity to uh, do some, we'll call it para planning, that's critically important. So I wanted to bring that to everybody's attention today, that we have asset protection issues. We have income tax issues that are involved. We have retaining the bonus exemption. We have the yin and yang of options that we have to deal with on all of these issues that are available. So the takeaway, and we're not going to be very long with each other this morning, is that we all need to continue to engage in significant planning. um, we want to make sure we get an income tax step up in basis. We want to make sure that no opportunity is lost. So I want to admonish everybody to take a look at that. And I just don't want us to be to believe that just because Trump was elected, that all of the tools, techniques, and exemption amounts that we have for the wealthy will remain. Good possibility that they will, but we should hedge our bets in taking a look at that. And like I said, income tax considerations and asset protection considerations. Um, so I gave you a bunch of things. We also can use limited powers of appointment to move things around, but the very, very strong use of trust protectors during this, we'll call it interim year. The one thing I can't emphasize this enough. If we get to later in the year and we've done no planning, there will not be a single qualified estate planner in America that will be available in the last 3 months of the year to deal with the issues that you face. It's millions of dollars that are involved. So with that, Paul, let's go over to that. That's kind of our updates on CTA, asset protection of retirement plans in California, and standby trusts and issues of the election for in 2024. Do we have any questions in the chat?
Yeah, so I've got a couple here, and I want to encourage everybody, put your questions in Q&A, or if you put it in the chat, I can see those too. And so a couple questions I see coming in here is on the Q-tip, how does it work with a second marriage? Are there circumstances there that
Yeah, a Q-tip trust on a second marriage may not work. Um, because when you make a gift into a Q-tip for a spouse, it has to be for the spouse. It can't be revocable. Spouse has to get all the income. So if we're making a Q-tip gift of $14 million, it has to have all the characteristics of a Q-tip trust, even though it may never become a Q-tip. We will not Q-tip it if we're looking to save the exemption. But when you're dealing with a second spouse or a third spouse or a fourth spouse, whatever it may be, we're talking about making a gift to the spouse. But now, on the other hand, we would in that circumstances, if there were children, we would create standby trust for the benefit of the children. You know, from the first marriage, you make a trust for the benefit of the children with all of that flexibility.
okay?
But a
What if the
Q-tip would
spouse,
not be applicable.
I mean, but what if the spouse passes away?
Well, if the spouse passes away on a Q-tip in a Q-tip trust, that trust would then be able to move back to me. So if I create a Q-tip trust for my wife passes away, it would move back to me and I'd get a step up in basis. And if I was going to lose my exemption, I wouldn't Q-tip it, and then it would go to my spouse, and then from my spouse to my children. So I would lock in that extra, $5 million worth of exemption that it's going to. So I kind of get the option both ways.
Okay. Larry's asking about trustee for a Q-tip. Who serves as trustee for a Q-tip?
Spouse could be your surviving spouse could be the
Okay.
trustee of the Q-tip. You could have a third party trustee. You can have anyone other than you. Sure, you can definitely have a trustee for the Q-tip.
Okay. And then Harry, when you're if somebody takes you up on getting with you and you're doing a review, what does that look like? How do you start that out? I mean, do you ask for
Yeah, well, we've got to take a look at what planning has been done so far, what trusts we have so far, the size of the estate, the value of the estate, whether or not there are discounts that are involved, the goals and objectives of the family. So we need to look at all the assets. We need to take a look at all the liabilities. That's the quantitative data, then the qualitative data, goals and objectives. For example, are we philanthropic? Do we want to use foundations? Do we want to use charitable trusts for the benefit of charity and not so much our kids? All of those factors come to play. We see where they have. We address the asset protection liabilities, address the income tax liabilities, and address the estate tax liabilities, and then come up with hopefully some great solutions for people to consider for their planning.
you often find solutions, Harry, new ones with folks who have planning in place already?
Sure.
Why? Because
Sure.
the planning's outdated or the
No,
laws?
well, sometimes it's outdated, but more likely than not, most planning that we see is on the simple side.
Mhm.
Um, it's pretty much on the simple side and basic estate planning, basic living revocable trust, things of that nature. And that those things don't provide the levels of asset protection and or estate tax protection That would be so. Life insurance, we see many times that is not included in a life insurance trust. So, although someone might have an estate of 8, 9, $10 million, but they have a $15 million worth of term life insurance that's in their estate, that makes their estate 25 million bucks. And so, the life insurance itself can create an estate tax. So, there are tools that we have to get the life insurance out of the estate and should be considered.
Wonderful. Any other questions here? Now's your chance to get access to Harry and fire away. We had a couple of good ones there. So looks like we're good, Harry. And I want to remind everybody that there is a link. Oh, that's the YouTube link. I'm going to put the link back up there to get one-on-one with Harry. If you want input or you have questions offline, let me just put that in chat right now. And what we'll do is we zoom that. So there's that link, and copy that link, and it is great. Get fresh input. Fill that out. We'll get you connected. Harry, thank you. Wonderful
Well, thank you
information.
guys. I wish that I didn't have to be quite as technical, but we're just in a very vague period of time, and we're talking about millions and millions of dollars for families that really need to be looked at. So at worst, let's take a look at everything together as partners and see what we could do to make everybody's family better off.
Harry, Steve's asking before we go, cost to set up a standby.
Cost to set up a standby, not so much, maybe a couple of $1,000s to do so because it's a very simple trust at this point in time.
Because you're not doing all the other bells and whistles with
No,
it, because you're not.
no,
Okay.
not at all. Set up standby planning. There's some planning that's involved. You set up a standby. You do it simply in California Irrevocable Trust, and we put all the add-ins later as auxiliary standby. But we are ready to go. We have all the assignments done. We have everything finished as if the law was going to change, and either we use it or we don't use it. And if we use it, we're good to go, ready to go. And if we don't use it, we make a $1,000 gift to the kids and call it a day.
Okay. Okay.
All right, guys.
All
Well,
right. Thanks, Harry.
thank you. Thank you, Paul. Thank you, everybody. It's good to see everybody again. Thank you. Bye bye.